I want to give you a simple investment strategy that will let you outperform most investment professionals, and you only need 3 funds to do it. Many individual investors overcomplicate things. They end up with like 10 or 15 different funds in a portfolio, and there's really no reason to ever do that. Often, many of their funds end up having huge overlaps anyway, so they're not really adding diversification. But you can be a great investor, and it can be very simple to do using only 3 funds. If you are familiar with the typical 3-fund portfolio, this video is going to cover a new and improved version that better reflects the world that we live in today. I'll even give you the exact funds to buy and explain why they are an excellent choice for any portfolio, whether you have $1,000 to invest or a few million. And towards the end of the video, I'll suggest an add-on fund to push the 3-fund portfolio to a 4-fund portfolio and potentially drive even better profits long-term with less volatility. Oh, and I'd appreciate it if you hit the like button and please leave some comments below. Okay, a typical 3-fund portfolio is a strategy that gets a lot of love from investors, and for very good reason. It can deliver strong growth and low risk over long periods of time, and it's so simple. Plus, it provides amazing diversification. If you're trying to figure out how to set up an investment, the 3-fund portfolio could be your solution. The 3-fund portfolio was first popularized by the Bogleheads, who are followers of the advice of John Bogle, the founder of Vanguard and considered the father of index investing. The Boglehead community follows very sound investment philosophies, and they offer some great advice. The original 3-fund portfolio is comprised of a U.S. stock index, an international stock index, and a U.S. bond index. The Bogleheads 3-fund portfolio doesn't have a specific one-size-fits-all asset allocation, though. The investor is encouraged to choose their own based on their own time horizon and risk tolerance. However, a common allocation may look something like this: 60% U.S. stock index, 20% in an international stock index, and 20% in a U.S. bond index. However, in today's world, I'm going to suggest an updated version that has been seriously outperforming this mix of assets over the past couple decades, and it better reflects the world that we live in today. Now, before we get into the specifics and the data, let's do a quick review of some of the benefits of using a 3-fund portfolio anyway. First, there's no advisory risks such as incompetence, conflicts of interest, and all the fees that they charge. There's no individual stock risks. Picking individual stocks notoriously underperforms the stock market over the long period of time. You automatically have a well-diversified portfolio. It keeps fees extremely low since you're investing in index funds with very low expense ratios. It performs very well for long-term investors with very little effort, and you can easily set up the asset allocations to fit your own needs. So, for the new and improved 3-fund portfolio, you want to keep the U.S. stock portion as your main category. In fact, it's a great choice as the core holding of any portfolio. For this, you can use either an ETF for the total stock market like VTI or one for the S&P 500 like VOO. Since neither ETF is equal weighted and most of the money goes to the big companies, there's really very little difference between them. The long-term performance is nearly identical. Either one is an excellent choice. If you like the idea of the total broad market fund, you can use VTI, ITOT, or Schwab's SCHB. If you want the SP 500, you can use VOO, IVV, SPY, or SPLG. Now, I understand bonds are meant to provide stability and less volatility, but over the long term, they end up putting a real drag on the portfolio's performance. Plus, they are not always safe. In 2022, when the stock market dropped 18%, the total bond fund was down over 13%. Let's go to the Portfolio Visualizer website to take a closer look how U.S. bonds have performed against U.S. large cap stocks, which is basically just the S&P 500. Let's first look at the past 10 plus years, where the compounded annual growth rate for bonds has been 1.43% compared to 11.86% for stocks. Bonds have been less volatile, but a $10,000 investment in bonds would have grown into $11,596 over those 10 years, compared to $32,147 for stocks. How about over 20 years? Bonds had a compounded annual growth rate of 2.89% and stocks earned 9.95%. Over 30 years, bonds earned a rate of return of 4.12% and stocks earned 10.13%. That's huge. Over 30 years, a $10,000 investment in the total bond market would have grown into $34,148, while the same investment in stocks would have grown into $187,969. Now, the standard deviation for bonds over that 30-year period was only 4.14%, compared to 15.55% for stocks. So bonds certainly smooth out the volatility, and that could help you sleep better at night when the rough patches happen. However, if you have a long-term horizon, you pay dearly for that comfort and less volatility. So let's swap out bonds and replace it with something with a bit of a steady income stream. For this, consider a dividend-paying index. I'm talking about something like Schwab's U.S. Dividend Equity ETF, SCHD. Its 5-year return is 13.36%, and its 10-year return is 10.99%. And remember in 2022 when bonds dropped over 13%? SCHD only dropped 3.23%, and we have the comfort of it paying a dividend every year, which is currently 3.4%. Now, its volatility is still quite a bit higher than bonds, but we have a steady dividend to help balance things out a bit. Now, be careful being tempted by other funds with much higher dividends. Those come with more risks. When funds are being made up of companies that are trying to attract investors by paying large dividends, those dividends are usually not sustainable over the long term, and they hurt the long-term growth of the company. Plus, when those companies get into the position of needing to lower the dividend a little bit, their stock price takes a major hit. SCHD is made up of very stable companies that have a long track record of supporting and increasing their dividends to the shareholders. We have companies like Texas Instruments, Chevron, Lockheed Martin, PepsiCo, and many others. And you might think there's a big overlap with the S&P 500, but the overlap is only 8%. So this fund not only adds more dividends to our portfolio, but it also adds more diversification. Another ETF to choose from this category would be Vanguard's VYM. It would be equally as good. Now, for the next adjustment to the old 3-fund portfolio, let's replace the international stocks. Decades ago, it made more sense to get exposure outside of the U.S. That's where the developing economies existed, and it made sense to get exposure to the emerging markets, intending to seek better growth and balance over the U.S. economy. However, in today's global economy, most of the large companies are truly global, and much of their revenue comes from outside of the U.S. anyway. In fact, approximately 41% of the entire revenue generated by companies within the S&P 500 comes from outside the U.S. Plus, companies within our dividend-paying fund, SCHD, are large global companies that have much of their business outside of the U.S. Take PepsiCo. They reported that 40% of their fiscal 2023 revenue was outside of North America. How about Texas Instruments? Japan alone accounted for over 21% of their revenue, and the combination of Europe, Middle East, and Africa accounted for another 47.8% of their total revenues. I could keep going, but I think you get the idea. So SCHD only has an 8% overlap with the SP 500, and you are getting international exposure outside of the US. So we still have a lot of international exposure. So consider replacing the international index with a growth fund. For the growth fund, consider something like QQQ, which corresponds to the NASDAQ 100 index, and that's been a major driver of the overall performance of the entire stock market in recent years. It's one of the few funds that's been outperforming the SP 500 in recent years, and that's hard to do. QQQ's 10-year average has been around 18%, and the SP 500 has been around 12.65%. Now, don't be thinking you want to put everything into this fund. Just because it's been outperforming recently, there's no guarantee that will continue. If the market weakens, this fund may suffer larger losses. In 2022, the SP 500 dropped 18%. QQQ dropped 32.58%. It comes with a bit more risk and reward, but you can keep the percentage of the portfolio devoted to this area within line with your risk tolerance. Now, QQQ does have a 45% overlap with the S&P 500, but at least 55% of it, therefore, is adding increased diversification. And just like our dividend-paying fund, most of all the companies are very global, adding to your international exposure. In fact, only about 52% of its revenue came from the US. Other funds you can choose from besides QQQ are the QQQM or Vanguard's VGT for this area. Now, I want to offer an idea of adding a fourth fund for an additional category. Since all the funds so far are made up of large companies, you could consider adding a fund made up of small cap companies, like those in either the SP 600 Small Cap Index or the Russell 2000 Index. Over the past 10 years, they've been underperforming the S&P 500 slightly. However, looking at the history of, let's say, the Russell 2000, which began tracking the performance of small cap stocks in 1979, the stock index has broadly matched, if not slightly exceeded, the performance of the S&P 500. Small caps have typically outperformed large caps during periods of economic turbulence, like from 1979 to 83, 1990 to 94, 1999 to 2014. However, large caps often outperformed in the later stages of bull markets and during strong phases of economic expansion. Plus, these small cap funds have a 0% overlap with the SP 500. Thus, we are really adding to our diversification, and that will help balance out more volatility. Here's a few funds to choose from for this category. We have VIOO, IWM, VTWO, or IJT. All of those would be fine. Okay, now let's talk about the allocation percentages just a bit. First, you only need to pick one ETF for each category, whether you choose the 3-fund or the 4-fund portfolio. If you're younger, you might choose to have a smaller percentage in the dividend-paying fund, unless you like the idea of just having less volatility. As you get nearer retirement age, you might want to start moving the percentage devoted to the dividend-paying fund category up a little bit. That should add stability and help increase passive income from your portfolio. Now, if you absolutely like the idea of having a bond category as you get near or you're in retirement, there's nothing wrong with that either. In that case, we could replace the small cap fund with a bond fund. However, in today's environment where CDs and high yield savings accounts are paying around 4 to 5% with zero risk of any downside, that may be a better choice. Also, keep in mind that any money that you may need to use within the next 2 to 5 years probably shouldn't be in stocks. It still needs to be invested and making money for you, but it should be in something that can't go down in value. You don't want to make withdrawals during a downturn in the market. If you really want to understand the studies on asset allocations, check out this video that I'll have linked below in the description. To sum things up, a 3 or 4 fund portfolio is really all you need. Don't overcomplicate things. This strategy should really be at the core of any portfolio. It's simple, low cost, and it's great for a long-term investor. Thank you for watching. Please leave some comments below, hit the like button, and consider subscribing.